Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are taking a look at the Target Corporation, ticker TGT. This is a stock that the chart looks a whole lot like Estee Lauder. They had a pretty rough year last year looking at things. Their earnings per share were cut down more than in half, and they're on the bounce back from there. They came in at 6.02 this last year. This year they're expected to do $8.34 by analysts at least, and moving forward, $10.30 the following year. They're expecting they had a modest growth in this first quarter of 0.6%. So I'm using that as a filler right now to project out revenue. They could do better, they could do worse. But let's get into this like we usually do. Revenue is good, definitely in line with what we like to see, with over 10% growth year over year, but their expenses have been creeping up even faster, 14.44 year over year. We see their expense as a portion of their revenue ratio has been climbing. This last year was super high. Prior to that, it was on the decline, 94, 93, let's just round up, say 92, and then it hopped up to 96.5. So hopefully this year they're able to come in somewhere around that 90, 91% level and just keep chipping away at that. But we will see as things progress. Their net profit has been declining, their EBIT has been declining, and their earnings per share have been declining because all of these calculations are based off of last year's numbers. That we had seen decent growth over time among those numbers. EBIT up 40%, up 43%, down 58%. So that 58 kind of wiped out all of the earnings from the prior years. And then for the net income, 33, 59, minus 60. So hopefully they can get back on a track more like they had previously. Share count, they have been buying back shares at a decent rate, buying back 2% a year up until 2022, where they escalated it and bought back 5%. So we'll see if that continues. They do have a budget where they will be buying back more shares as this year goes on. Shareholders' equity declined a bit. It grew from 2019 to 2020, and it declined, and then it declined. So that's not really what we want to see. It looks like their liabilities are outpacing their assets in growth. Not a very good sign. Their free cash flows last year, they were negative. We had good number in 2020 for sure. 2021 was still good. A big decline from 2020, and then it just went off the deep end in 2022. Assets, we see good growth, 7.63% year over year. Tangible assets have been decreasing though, and the liabilities have been growing at a much faster rate, almost on pace with the top line revenue. Tangible book value, we do at least have a positive value, a strong positive value. It is down just slightly, and it grew from about 12 to 14 to 13 to 11. And then we have the book value per share at the end of last year was $24.31, and the cash on hand was $4.82. The dividend, they are a very fast dividend grower. This last year, they grew it 20%. On average, they've been growing at 17.84% year over year, which is just incredible. And their yield, of course, is growing at a very fast rate as well. We see that it's grown from the low 1% to almost 3 to almost 4 if they continue the trend that they're on and remain at current levels. They'd be yielding 4%, which is very impressive. The PE ratio, we see it's in the mid-teens, low 20s, 19, 20, 16, 26, and then 16. So it's almost like we're catching back up from the 2022 bad numbers with the price recently, and it's been dropping and dropping and dropping. I get a fair value for 2022 of $63, and moving forward, if they're able to continue on the pace that they've shown previously and perform as expected, they're going to be valued at $132, which is right about where the stock stands today. So I'd say it's at a fair value. If they can get back on track, this stock could go up. It's another one like Estee Lauder, where if they can get back to their 2021 trend, we could see this stock almost double. Personally, with what I'd like to see in the stock, maybe 25 is a bit high, but if we cut this down to 20, like my personal valuation for the stock is I'd be willing to pay $162 for something like this. And we can see all of the metrics are over the current share price. So I feel like it's at a good value. Ideally, we'd be buying it around the $105, $106 level. But who knows if that's going to happen. Now would be a good time to start averaging in a position if it's a stock that you're interested in. So let's take a look at the chart and see what I'm talking about. We see it's a lot like Estee Lauder's. It climbed up and up and up, and it hit its peak in 2021 at $261, and it's been on a downtrend since. They hit a huge bump here, 5.8 to 5.29, just straight down. And right now they're like dancing with that fair value. They're just below the line that I've calculated if they can come in on guidance and trend. The buy zone would be down here. So we'll see if they reach this buy zone. It looks like if they do continue down, there might be a bit of support at this $129 level, and then quite a bit of support and resistance lines here at the 117. So that might be a more likely place to be able to scoop it up. But, ideally we'd get 105. It had just had enormous growth starting in 2018. You can see it was off like a rocket to the moon, and it's coming back down to trend. There's great growth within the stock, but it was just at too high of values for how it was performing fundamentally. And it's coming back to its fair value now, which we hope for an overcorrection where we can capitalize off that. So let's look at these earnings and see where these numbers are coming from and what they're expecting to happen. Here we have the first quarter earnings report. I might be a bit late on this, May 17th, but I come out with one a day. So I'm getting to it now. I had someone ask me to do this one, so I figured I'd take a look. I know it's been a beaten down company, and the retail space is a little tough, especially right now. So they say that continued traffic and sales grew even in the challenging environment. They came in with earnings per share of $2.05, down 4.8% from last year. Adjusted, that's $2.05 as well, down 6.2% from last year. They say that they have the ability to flex across their multi-category portfolio and to lean into the value of product categories that guests need the most right now, which would be foods and just staples that most consumers are buying in an inflationary environment such as this, which help to increase guest traffic, and their total sales and profitability came in ahead of expectations. Even with that, they still hold their guidance. So they're not getting their hopes up for the rest of the year, it looks like. They expect that shrink will reduce this year's profitability by more than $500 million. So they have a huge problem with theft, expecting $500 million of merchandise to be stolen from them. And they are maintaining that full year guidance. So the guidance is the second quarter, somewhere between $1.30 and $1.70 in EPS. For the full year, somewhere between $7.75 and $7.85. So we can go back and take a look. The analysts had $8.34 for this stock. So we can adjust it to the higher end of their range and see how that changes our valuations. And it might become an even better deal. So it was $8.74 that I can update at 75 cents. I can update this to $8.75. So that would have helped with their earnings calculation down here. And it brought its fair value up to 133. It brought like another $1 to $2 in value to the stock, raising the fair value and the buy zone a little bit. So it becomes a little bit of a better deal here. You're getting it for $2 to $3 under the fair value. And then that is all for their guidance. As for their operating results, comparable store growth of 0.7%, but digital sales were down 3.4%. Total revenue of $25.3 billion, which was growth of 0.6%. So it looks like the consumer wants to see the products that they're buying or something. The COVID boom in online purchases is dying down. If they're seeing 3.4% decline there, not the proportional amount of growth in same-store sales. So online customers might just be going elsewhere too. Operating income margin was 5.2% compared to 5.3% the previous year, growth margin of 26.3%. And we can take a look at how they've historically performed on these metrics. We have their 2.5. So they're coming in with about twice the net margin that they had last year, which is very good. And the gross margin is low for how they typically perform. It looks like they shoot for 29 to 30. Last year was 24.6, and right now they're in the 25 range. So it's up, but not to what they would like or what we would like. They say that freight costs are lowering, retail prices were increased, they're marking down less items, lower digital fulfillment costs because of the lower volume, and a favorable mix of lower cost same-day services. So those have all helped to offset the inventory shrink. They keep mentioning this, so theft must be a huge issue for them. Their interest expenses climbed almost $30 million, so debt's coming due, or they're on variable interest rates, and those are raising their interest expenses. They didn't repurchase any stock in the first quarter, but they have $9.7 billion remaining that was authorized by the board of directors. So that $9.7 billion will be coming at some point in the year. Either they don't think that their stock is really cheap enough and it'll keep going down, or they're just waiting for a good time to deploy that cash. Their return on invested capital was 11.4%. And then we get down to the actual numbers. Sales growth of 0.5, that's okay. I mean, it's just the first quarter. Total revenue growth of 0.6. Cost of sales down 0.4. So there we go. We get almost a 1% difference there between the sales growth and the decline in the COGS. And we come down to a net earnings decline of 5.8%. So other expenses seem to have hurt them. Net interest expense, we did say, was 30 higher. And then we see that their depreciation was less as well. And it looks like the majority of the difference comes from those two. EBIT down 3.6%. Again, I mean, that's coming from less depreciation and a higher interest expense. So although their COGS are coming down, some of their expenses are coming down, their financing expenses are rising, and they have quite a bit of debt. Share count down 0.7% over the last year. So it looks like last year they deployed a lot of that capital in the first quarter. They're holding on to it right now. Dividends, they are up 20% from 90 cents per share to $1.08 in the quarter. We come down to assets. We see assets did shrink a little bit, going from 53.3 to 52.1. And then current liabilities are down from 19.5 to 17.9. Total non-current liabilities are up from 22.6 to almost 22.7. And that's all for the balance sheet. For cash flows, they're burning through cash. This quarter of last year, they had spent almost $5 billion of their cash reserves, and they almost spent a full billion this quarter. This quarter last year, they had 1,112, and this quarter they had 1,321. Another piece of interest, stores, they opened a few stores. Mid-sized stores, they opened 3, and small stores, they opened 3. They don't have a whole lot of these massive stores. And they're slowly adding to their store count. That's what we get from these earnings. So one concern here, they might be at a pretty fair value, but their debt, their balance sheet isn't in the best of shape. I mean, at least they have a positive tangible book value, but they're paying a lot of interest on this debt. Like, look at this debt compared to these assets. 2019, they had $23.16 book value per share. It climbed 29, dropped 26, dropped 24. We'll see what this year comes into, but that's not a trend that I like, where we're seeing a decline year over year of almost double digits, 9 and 8. I'd like to see this stock go a bit lower. If it's been something on your radar, it might be something to buy. I'd want to see a little bit more out of it before I give it a buy rating personally. And I'll look deeper into it and see if I can come up with a thesis, because it has potential, but the red flags would be their debt and their expenses. They've got a little bit of a handle on those expenses, it seems, but the debt, not so much. So thank you guys for watching this one. Please like if you enjoyed the video. Subscribe if you want to see more like this. Comment, let me know. Do you agree with what I'm saying? What other stocks would you like me to take a look at? And I will catch you guys next time.